with a bunch of economists who are joining us to make better sense and decode the governor's words right now. We have Mr. Indranil Pan, the chief economist at Yes Bank. Joining him, we have Mr. Sachidanand Shukla, group chief economist at Larsen and Toubro. R. Gandhi joins us, former RBI deputy governor. We have Mr. Gandhi on the show as well. And along with all of them, Mr. Jayesh Mehta, vice chairman and CEO at DSP Finance, also joining us on the show. Gentlemen, a very good morning and thank you so much for your time today. Mr. Pan, let's start with you. Your first takes of the policy right off the bat. GDP guidance hiked, inflation guidance lowered, and stance continues to be neutral. Your thoughts?
I think we were wrong on our policy call. We were expecting that the policy should not be cut. But having said that, I think if I read the mind of the governor and the MPC, it is possibly playing on the fact that the CPI inflation has been lower, and he kept telling during the interaction, he kept telling the markets that the core inflation has also been significantly lower, and whatever impact on the core we see, 50 basis points is out of the increase in the precious metals prices. So therefore, he utilized the opportunity that he had in the policy. But more important than the rate cut and the neutral stance, I think, is the steps that he has taken on the liquidity perspective. And once again, like the early cuts that he had done on the CRR side, the direction on the liquidity is quite clear in terms of the OMO of 1 lakh crores that he has announced for the current month, and the sell-buy swap in terms of the rupee dollar. So all that points to the fact that his intention is to keep the market liquid, and even therefore, as rate cuts are seen, the impact on the NIMs because of the liquidity being on the relatively better side may be just transient and may not be too deep.
Definitely, I want to come to you, Jayesh, to understand the impact on the bond yields because the 25 basis point cut has been announced. Anyways, the rupee was under pressure separately, but how do you see bonds will react to it?
So bonds have right now, taken the stance because the stance is neutral. Plus, bond market players worry a lot, right? So they always think, okay, this rate cut has happened, so now what next to look further, right? But I really won't be surprised. So the immediate reaction is not dramatic. So it has just moved 3 basis point, 4 basis point. But maybe, as people see that this OMO, which has been announced in December, 100,000 crores. Maybe there will be further OMO coming in Jan-Feb. I do expect another at least 75,000 crores OMO coming in Jan-Feb, March, right? So I think that will further bring down the yields at that juncture. And stance neutral, I think last time also Governor explained, I think earlier also, when we say neutral means basically next time RBI may raise rate or cut rate or could do anything. It's either side. Whereas people have been expecting that is slightly differently. But I would not too worry much about that. But yeah, as far as the market is concerned, they have taken it cautiously. Of course, there is a supply overhang also on the long end of the bond. That is also weighing on the bond market. But this OMO plus further OMO coming in Jan-Feb will bring down the bond yields dramatically.
Okay, so the OMO is going to have an impact on the bond yields, but let's also get into conversation with Mr. Sachidanand Shukla. Mr. Shukla, what do you think the impact of this OMO operation and the 3-year dollar-rupee buy-sell swap that has been announced? Is that going to be enough to keep the rupee under control? Because more than 90 is where the rupee had touched and now come back below that. But do you think these measures are enough?
So I think this will go down as a very, very bold and audacious policy. If you look at what the backdrop is, with the 8% kind of GDP print and the currency really being down close to 6% during the year and one of the worst performing currencies, one does not expect a central bank to really cut interest rates. I mean, on the contrary, people would expect the central bank to really raise rates. So I think this is a very, very different take and a bold and audacious policy from the governor. Clearly, he doesn't believe what Ben Bernanke said, that monetary policy is 98% talk and 2% action. I think he believes in action very, very clearly. As far as the guidance on liquidity, very, very clear, very important. He's mentioned that he will maintain 1% of NDTL, 2.5 lakh crore. But some of that is not usable as it is used for cash management and LCR requirements. And also the backdrop is that Forex swaps are going to be maturing. So does one roll over? If you do that, it makes it cheaper for speculators to fund long US dollar positions. And with rupee at close to 90, it's not a good move. So does the central bank therefore give delivery? With that, the INR liquidity will go down, but it is manageable via OMO. So therefore, the 1 lakh crore OMO. And also he's announced that 3-year swap, which is to take care of this problem. So in my belief, I think with a clear pro-growth stance, the growth differential is going to be more important than the interest rate differential. And that should really support the rupee going forward, because if you look at the global context, the trade deal is still a pie in the sky. I mean, we've been hoping for it, but it's not come through. One doesn't really know how long will it take to get there. So with that kind of backdrop and pressure on the rupee, I think the moves on liquidity, the swap, and the OMOs, and also a very clear pro-growth stance is going to really support the INR. Back to you.
Understood. Point well taken. Mr. R. Gandhi, I want to come to you for a reaction, and particularly on the inflation front. 0.6% is the guidance which has been given for the current quarter, and last month you would have seen 0.25% was the number. I want to understand from you, 2 to 6% is the mandate of MPC. Do you see it may be breached soon?
Yes, first of all, the measures announced by the governor is as per expectation. That is one. And to your specific question relating to the inflation, inflation trending down well below 2%, the lower corridor of the MPC mandate is worrisome. Then naturally, we'll have to pump up inflation. For the first time, I would think that in the Indian economy, we are talking about pumping up inflation. So and especially in the last count, the rural inflation had kind of gone to a negative territory. I suppose that it is only temporary. Hopefully, it should be back soon. And that would mean that we have to support growth and production. That is what is the policy has been targeting now with rate cut and liquidity announcements that has been made by governor, in the sense that because deposit growth has been lagging behind credit growth, some additional resources will have to be made available to the banking system for sustaining the growth prospect. That's why the additional resources that are coming. So inflation down the line, the efforts will be to bring it above 2%. And the projection, of course, is in the coming quarters, the MPC projections are that it will be 4 plus. So that is good. So that's why it is as of now, the measures announced are in the right perspective. That's what I would.
Okay, so that sounds good. Mr. Pan, weigh in here and give us your take on the comment that the governor made. Rare comment saying that we currently are in a Goldilocks economic scenario right now. Do you concur with that statement? Because yes, GDP inflation look comfortable right now, but the most recent IIP data, that has been very disappointing. How do the macros play out right now?
So coming to the IIP data first, I think a single month's number at a 0.4% doesn't really change much, because the IIP number would also be influenced by, because it's a production number, will also be influenced by the number of holidays that we had during that month. So I'm not really looking at the IIP in a very critical way to that extent. Obviously, I think for the Reserve Bank or any central bank, this is one of the best economic phase that you can see, growth being on the higher side, but the growth is not being pressured by excessive demand for goods, which necessarily means that the inflation is on the lower side. And that is the opportunity that I think that the governor and the MPC has taken to actually provide this additional push to the economy to ensure that growth remains relatively elevated. Now, during his commentary, he also did point out that there were some headwinds to growth that were forming. And broadly, the second half growth is likely to be weaker than the first half growth. So the rate cut is likely, therefore, to work as a buffer to the downside to the growth that most of the market, including the RBI, is expecting in an atmosphere where the opportunity to do so is given to the governor by the lower inflation numbers, and especially when it is less than 2%.
Mr. Pan, I want to come to you for a comment on the scenario of remaining rate cuts, which you may see now, because 0.25% has been given now. Do you see there is a possibility in this fiscal year there may be a further rate cut, and more so in the next calendar year? What is your expectation?
I think we are in such a phase in terms of the monetary policy rate cut journey that it will be extremely hazardous to make a guess immediately after we have seen 125 basis points cut. Now, given the landscape in terms of the inflation that he has pointed out, and given the fact that the RBI is a forward-looking central bank, and with a Q1 inflation for the next financial year at 4%, the monetary policy report that had come out during the previous policy had actually put the inflation forecast for FY27 at 4.5. Possibly that will come down when we see the next report on the monetary policy. But having said that, I think given that the RBI is a forward-looking central bank with a 4% inflation, a 5-quarter repo rate at this point in time, I repeat, at this point in time, looks the right space where we need to be. So a lot of developments needs to be watched out. The global sort of perspectives, the domestic perspectives of both inflation and growth, whether the GST pull on the consumption demand continues or doesn't continue is another factor that we need to look at before the RBI can take an incremental decision. But I think the clear message from the RBI is that it is likely to keep the system well oiled so that the credit growth that has started to happen and more towards the retail side sort of consumption credit that is the offtake that we are seeing from the banking sector is likely to, or the platform is getting created to ensure that it likely continues. More from the liquidity perspective, in my opinion, than from the rates perspective.
Okay, and Mr. Shukla, help us understand the way the Indian market has been performing right now. Our economy is really strong right now. But given the way urban demand is recovering and we're seeing a lot of domestic interest, do you believe that India is well immune to external shocks right now? And anything on the US trade deal front will only be positive going ahead? And are we more domestically anchored now as an economy?
Well, clearly, I think in terms of the growth orientation, it is tilted towards the domestic side. We have seen the rural side really doing well in terms of the Rabi and Kharif outlook as well as the momentum or what we have seen. The urban side has come into play with the income tax cuts, the GST cuts, and the continuing rate cuts from RBI. I think it will be hazardous for us to believe that we are immune from global pressures. We have seen country after country or really coming under pressure from the uncertainties that are emanating from the US. So US is a source of policy shocks as we see for economies and markets. With a trade deal, even with a trade deal, we are seeing that many a country is facing issues in terms of lack of clarity. These are all presidential decrees rather than clear-cut, detailed trade agreements. So I think the degree of uncertainty is going to continue going forward, and it will not be prudent to really think that we are immune from these pressures going into the next year. But having said that, I think it's very clear from the steps that the governor has taken and the MPC has taken in terms of going whole hog in terms of preserving growth. And the growth differential is a clear-cut move that will probably shield India from the global vagaries. And definitely, the momentum is going to remain domestic.
Definitely, Mr. R. Gandhi, I want to come to you to understand the scenario with weaker rupee. Governor did mention the Forex reserves at $686 billion. But having said that, Reserve Bank of India has mentioned several times that they will not intervene at level. But the scenario which has been there for the past 1.5 months particularly, how do you think that it will pan out, and particularly you think that the tone would have been more or these concerns would be addressed in the statement as well?
See, exchange rate policy of the Reserve Bank has been consistently stating that they do not target a particular rate. It is always to manage the volatilities in the exchange rate, because this is a day-to-day movement depending upon various factors, supply and demand side, whether imports, exports, flows, capital flows, so many things are taken into account. It is a day-to-day affair. So, and monetary policy, again, very often Reserve Bank has reiterated that monetary policy will not be dictated by the exchange rate compulsion. It is more with reference to managing inflation and growth perspective, and exchange rate is in the order of third priority or lower only. So the exchange rate will have to be managed by Reserve Bank through other tools. And in the policy, of course, in the governor's statement today, he has indicated how Reserve Bank is going to manage the exchange rate in terms of announcement of this swap and other thing. So that way it will be continuously monitoring. It is a day-to-day affair, and you will not be able to come to the conclusion if they are targeting a particular level. That has never been the policy. Again and again, they are retreating. Somehow market is not wanting to believe that. I do not know why. So the managing the fluctuations, volatility is the priority, which is what they will be doing. And in the past 1.5 months, as you mentioned, that rate has been going in one direction, and the depreciation of rupee is happening more because of the recent developments. That is because the last previous month, the imports have been higher than the exports. The trade deficit had expanded, so market has reacted to that, and by the FII flows in the recent weeks or recent days have been little extra. That is also normally happens around the year-end calendar year-end. So that will be managed, and going forward, that Reserve Bank will be adapting, stepping up its actions based on day-to-day.
Okay. And Mr. Jayesh Mehta, what in your view could be the threats or the risks to the GDP and inflation outlook given by the governor today?
So I think at least it is supportive for the growth, the rate cut. Inflation outlook, I think I would say it's more on downside, because the way we are hearing from the global economists and stuff like that, you see the inflation was controlled mainly by Chinese exports globally, right? And since 2018, a lot of global exports from Chinese export to US have now moved to other countries, and therefore we do expect that in next coming years, maybe Asian inflation can actually look to structurally change for a lower inflation going forward. So even RBI has reduced forecast from 4.5. It actually started for 4.9 to 4.5, and now 4% for the next quarter, the next financial year, first quarter. So I think on the trajectory side, inflation looks benign. Growth, of course, 8.2 was high, and then it was supposed to taper down, which is what they're in their projection. But definitely the rate cut, liquidity measures, this is all supportive for the growth. So hopefully, both, I think inflation would actually come much lower, and maybe growth, wishful thinking, growth can be higher.
All right, so growth can be higher. And on a similar question, I want to come to you, Mr. Pan, because average out of Q1 and Q2, it becomes 8% for the current financial year, and the central bank has projected 7.3%. Why I'm asking this question? Because projections, particularly in last 2 quarters, have been much lower than the actual growth. How much, in your assessment, the GDP growth will be?
Well, I'll try and answer this question in a slightly different way. And as all of us know, we will be seeing a new sort of year base in terms of the GDP numbers that will come out on the 27th of February. And the whole weighting structure on the inflation is also likely to change. Now, most of the projections that we talk about today is on the basis of the 2011-12 base year, but for both GDP as well as the CPI, which in my opinion can actually change quite a bit when the new base year and the new weighting diagram actually comes, especially for the CPI. So as per the current data, I think we were also at a 7.4% growth. So the RBI is whereabouts. And the uncertainties have increased so much that every day, every month, you will have to factor in the newer perspectives that are getting thrown at you to understand what the growth dimensions will be. So, for instance, if the US-India trade deal doesn't happen in a very short while from today, we might actually have to build in a slight downward bias to the growth. Or if the GST-led consumption boost doesn't continue, so that's another downward bias to the growth. So there are lots of information that needs to be sort of pulled in before we have a confidence on the projections, both on the GDP and the CPI.
Sure. Okay. Thanks for that perspective. And lastly, Mr. Shukla, give us your sense on what you think the next policy meeting might hold, given that the stance still continues to be at neutral. Do you believe another rate cut could be on the cards? Are we looking at a pause going ahead, or maybe a change in stance?
Like Mr. Pan really explained it very, very well. Going forward, the whole way we look at the data might change. The recast of data has thrown some googlies in the past. And what it does, it will make the rear view mirror foggy and also the windshield foggier, right? Some of the policy measures might therefore look like being incongruent to where we are today. And therefore, I don't really think that the RBI will be hasty in terms of jumping the gun either on rates or the stance. I think it is at a very, very appropriate level. It will continue to monitor data, continue to monitor the uncertainties from the global side. And the other uncertainty I mentioned at the beginning.
Right. Point well taken, Mr. Shukla. Point well taken, Mr. Shukla. And due to paucity of time, I am interrupting in between. But thank you so much for joining at this hour, Mr. Shukla, Mr. Pan, Mr. Gandhi, as well as Mr. Mehta at this hour, and explaining the rationale behind the Reserve Bank of India's move. With this, it's time for a wrap in this special coverage from Reserve Bank of India.